Never feel like you're just swimming in financial news. But so I'm not quite sure what it all means for you.
Oh, absolutely.
Between trade headlines, big company announcements, what the Fed's doing.
Yeah.
It can feel pretty overwhelming.
It really can. Like you need a decoder ring just to manage your money.
Exactly. Well, today, we're going to try and be that decoder ring.
Right. We're not just skimming the surface. We're taking 5 pretty significant financial stories that are out there right now, and we're going deep. We want to show you how they connect directly to your wallet, your savings, even your investments.
Think of this as your personal guide. We'll cut through the noise.
Yep. We'll unpack the latest on U.S.-China trade tariffs.
Okay.
Anheuser-Busch's big U.S. investment.
Heard about that one.
The White House order on prescription drug prices, the Fed's interest rate decision.
Always important.
And that Skydance-Paramount merger happening in the entertainment world.
Okay, quite a mix. The goal here is really to give you clear, actionable insights, right? So you can navigate all this with, well, a bit more confidence and maybe less stress.
Couldn't have said it better.
All right, let's jump right in then. This U.S.-China tariff news, a 90-day reduction. What's the actual story there?
So the core of it is this. For the next 90 days, the U.S. is slashing tariffs on a lot of Chinese goods, bringing them down from like 145% to 30%. That's a big drop.
Huge drop.
And China's doing something similar for U.S. goods, going from 125% down to 10%.
Okay, but you said 90 days. So this is temporary.
That's the key thing to remember. It's a window, not necessarily a permanent change. A truce, like you said earlier.
Right, a truce. So for people just trying to, pay the bills, how does this actually affect us? Will things get cheaper at the store?
Potentially, yes. Or at least prices might stop climbing so fast on certain things. We import a lot from China, electronics, clothes, you name it. In this inflationary time we're in where everything feels expensive, even just stable prices for a bit could give household budgets some breathing room.
Okay, a little relief maybe.
It could also be a sign, a signal about negotiations. Businesses will be watching closely to see if this lasts or if costs jump back up in 3 months.
That makes sense. The bit of a pressure valve, perhaps.
Yep.
Now, what about investments? For those of us with money in the market.
Well, generally, lower tariffs are good for global trade. They sort of grease the wheels.
Right.
So big multinational companies, especially in tech and manufacturing, think Apple making iPhones in China or Caterpillar selling equipment globally. Lower tariffs can mean lower costs for them.
Which could boost their profits.
Exactly. And potentially their stock prices. So if you're invested in, say, international mutual funds or ETFs, especially those with exposure to Asia.
Okay.
You might see a bit of a positive bump from this in the short term.
All right, so the takeaway on tariffs. Consumers might see a slight ease on prices maybe. And investors with international funds, particularly Asia-focused, could see some short-term gains.
That's a good summary. Keep an eye on it.
Okay. Now let's switch gears. Anheuser-Busch, they're putting a lot of money into the U.S., right? $300 million.
That's the number, $300 million. A big chunk is going into a new technical center in Columbus, Ohio.
And they're also doing something with veterans, I read.
Yeah, partnering with programs to help military vets get into manufacturing jobs. So it feels like, more than just building a facility.
Definitely. So for the listener's wallet, what does an investment like that mean? Does it trickle down?
It certainly can, especially locally. A big project like that in Ohio usually means new jobs, maybe better wages in that area. It's a local economic boost.
Right.
And maybe it signals a bigger trend, too.
Yeah.
Companies focusing more on regional supply chains after all the global disruption we've seen.
Interesting. So less reliance on overseas.
Potentially. And for investors, seeing a major company like Anheuser-Busch reinvesting heavily at home, that can look like a sign of strength and resilience.
Resilience against those international issues you mentioned.
Exactly. It can make investors feel more confident about the company's long-term prospects. So maybe good for their stock and perhaps for other consumer goods companies doing similar things.
Okay, so the key insight here. Big domestic investments like this signal a focus on national strength, which could be good for long-term portfolio stability.
Precisely. It suggests a strategy focused on, shoring things up at home. That can be reassuring for long-term investors.
Got it. Okay, moving on. This next one feels like it could directly hit a lot of people. President Trump's executive order on prescription drug prices. The potential cuts sound huge.
They really do. The headline is about capping U.S. drug prices at the lowest price found in other developed nations.
Lowest of price, wow.
Yeah, they're talking potential reductions of up to 90% for some drugs. And there's a tight deadline, like 30 days, to get price transparency going and start negotiations.
90%. That's enormous. For the listener, the savings could be massive, right?
You're right.
Especially for retirees or people with chronic conditions.
Oh, absolutely huge.
Sure.
If this goes through as planned, it could mean a really significant financial relief for millions. Just imagine freeing up that much money in your budget.
It really would be a game changer.
Yeah.
But what about the companies? The pharmaceutical industry, how does this hit them and what does it mean for investments?
Well, the immediate reaction is likely negative for the big drug companies. Lower prices generally mean lower revenues. Right.
Stands for reason.
So you might expect some pressure on the stocks of companies like Pfizer, Merck, Johnson & Johnson, at least in the short term.
Okay.
But it's not necessarily bad news for everyone in healthcare. Health insurance companies might benefit, maybe generic drug makers too.
So it shifts things around within the sector.
Yeah.
For investors then, it's maybe about diversification.
Exactly. As a consumer, lower prices are great. As an investor in healthcare, maybe you want to spread your bets a bit. Don't put everything just on the big brand name pharma companies right now.
Makes sense. Balance potential losses with potential gains elsewhere in healthcare.
That's the idea. Okay, let's talk about the Federal Reserve. Interest rates. What's the latest move or non-move?
Right. They decided to hold steady, kept the benchmark rate in that same 4.25%, the 4.50% range. They mentioned sort of mixed signals in the economy, business slowing down a bit, but inflation still sticking around.
So what that means for you, the listener, right now, is that those higher interest rates on credit cards, car loans, mortgages, they're probably not going down just yet.
So no relief on debt payments anytime soon.
Likely not immediate relief, no. It's that tricky balancing act the Fed has trying to cool inflation without causing a recession.
Okay, so high borrowing costs stick around. Is there any good news on rates? For savers, maybe?
There is, actually. That's the flip side. Because rates are staying up, savings accounts and CDs are still paying pretty well compared to recent years.
Right, I've seen offers around 5%.
Yeah, you can definitely find high-yield options paying 5% or maybe even a little more. So it's a good time to make your savings work a bit harder for you. Definitely worth shopping around.
Good point. And for investors, what does a steady Fed rate mean for the markets?
Well, it can bring a bit of stability to the bond market, which is good. Less volatility there.
Okay.
But it can keep pressure on growth stocks, especially tech stocks. Higher borrowing costs make it more expensive for them to fund expansion, which can sometimes hold back their stock prices.
So tech might feel the pinch a bit more.
It can, yeah. Investors should keep that in mind.
So the key takeaway on interest rates: buckle down on paying off high-interest debt, but definitely look into those high-yield savings options while they last.
Absolutely. Prioritize the debt, maximize the savings. And for investors, keep that portfolio balance, some growth, some income-producing assets. It's still a sensible strategy.
Gotcha. Okay, last one. The entertainment world. Skydance Media and Paramount Global merging. That sounds like a big deal.
It is. A $28 billion agreement to combine two major players. It still needs regulatory approval from the FCC, though.
Right, the government has to sign off.
Yeah.
So for us at home, does this mean my Paramount Plus subscription cost is going to change tomorrow?
Probably no immediate change to your streaming bills.
Right.
But the longer-term question is about competition.
Fewer big companies competing.
Exactly. When major players merge, sometimes, down the line, it can lead to less competition, which could mean higher prices eventually, or maybe less variety in the shows and movies offered.
Something to watch.
Yeah, and it raises questions about how they'll bundle things, you know? Will content become more exclusive, less exclusive? We'll have to see.
And for investors in media stocks? Upsides, downsides.
Well, investors and the companies involved might hope for benefits from bigger market share, maybe cutting costs, those kinds of synergies.
Okay.
But there's always regulatory risk. Will the deal even get approved? And sometimes the promised savings don't quite happen.
Right.
So if you invest in media or tech, you'll want to watch how this reshapes the streaming landscape, impacts advertising, that sort of thing.
So the message for the listener is, watch for potential consumer changes down the road. And if you invest here, make sure you're diversified because mergers bring opportunities, but also risks.
That sums it up well. Diversification in communications and tech helps manage the potential bumps from any single deal like this.
It really is amazing how all these different stories trade. Corporate spending, Drug prices, interest rates, media mergers, they all weave together.
They absolutely do.
And they all eventually land somewhere in our personal financial lives. Trade affects prices and our international stocks.
Right. Corporate investment impacts local jobs.
Government rules hit healthcare costs.
Fed decisions touch borrowing and saving.
And mergers change the services we use and our investments.
That interconnectedness is exactly it. So thinking about everything we've discussed, there's some concrete things, listeners, you can maybe think about doing.
Okay, let's wrap up with those actionable takeaways. What should people consider?
All right. First, maybe review your investments. Are you too heavily weighted in one area that might face challenges, like maybe pharmaceuticals in the short term? Check that balance.
Good point.
What else? Second, those savings rates are still good. Don't sleep on locking in a high-yield savings account or CD while you can get maybe 5% or so.
Capitalize on that, okay?
Third, debt. With rates staying high, if you have credit card debt or other high-interest loans, really focus on tackling that aggressively.
Makes sense.
Fourth, diversification again, especially if you invest in healthcare or media, given the potential changes we talked about.
Right, spread the risk.
And finally, just keep thinking both globally and locally. What happens with China trade matters, but so does that Anheuser-Busch plant in Ohio, It all connects back to your finances.
That's great advice. So, looking ahead, what's the big picture? Still expecting some bumps in the road for investors?
I think we have to anticipate continued volatility. Inflation is still a factor. Global tensions aren't going away. Policy changes can happen.
So stay nimble.
Exactly. But based on what we see now, maybe some moderate growth short-term in consumer goods, manufacturing. Be a bit cautious on pharma for now.
Okay.
Medium term, if that China trade truce holds or improves, global and emerging market funds could see a lift.
Interesting.
And longer term, with the focus on domestic investment, infrastructure, U.S.-focused portfolios, things like infrastructure, manufacturing, financials, they could be positioned well.
So a mix of caution and opportunity depending on the time frame and sector.
That's often the case.
Okay, so a final thought for everyone listening as they try to make sense of it all.
Yeah, I'd say stay informed, be ready to adapt your plans, and just remember that all the small financial choices you make consistently, day by day, they really do add up and make a difference, especially in a world that's always changing like this.